Contingent deferred sales charges. Um, this is the mechanism by which the B and C shares are sold. And honestly, it's really what 25 years ago really helped the industry pull in more cash, because of the way the contingent deferred sales charge is presented to the public, um, is that there's no real commission paid as long as you don't sell that investment over a given period of time, the holding period. And it may have CDSC, contingent deferred sales charge. It may have a CDSC of 6 years or 8 years or even 10 years. So the way the industry has presented it to investors to make it a little more palatable to invest is that as long as you invest that money with XYZ mutual fund company and you leave it there and don't pull it out for 6, 7, 8 years, whatever that holding period is, then there's no commission paid. Hence the clever way they came up with contingent deferred sales charge. Clearly the implication being that sales charge is contingent on some event. That would be you selling it, taking the money back. It's deferred, meaning you don't have to pay it. It's deferred to some future date. As long as you don't sell it, then there's no commission paid. And so contingent deferred sales charges were much more popular than the A share option. Remember, this is all about options. The industry has taken made the conscious decision to offer you, the investing public, multiple options in terms of how you pay for investment advice. And with the point being, if you're not sold the correct option given your specific investment time horizon, you're going to pay too much. You're going to be overcharged. And the industry has said that money should be refunded to you. So that's part of what I'm helping with here, is helping you to define whether or not you were sold the correct option, and if not, potentially how much you might have been overcharged. So the key again is how that option is phrased, contingent deferred. And you invest, let's say $100,000 in XYZ mutual fund company, and it's got a CDSC of, let's say, 6% in a 6-year holding period. Well, so what happens is that mutual fund company, since the CDSC is 6% on $100,000, that's 6% of that's $6,000. So you invest that with your investment advisor at the local bank or at a major brokerage firm. The mutual fund company is going to advance to your investment, to the brokerage firm, ultimately to your investment advisor, $6,000. But you're responsible for repaying that. They're going to hold your $100,000 as collateral until you've repaid that. So you borrowed that money. And I'm not sure I touched on this in video 1, but since you borrowed that money, it's possible to calculate the interest rate. So if you can factor in what the interest rate is on the CDSC that you were sold, then one can also determine whether it would have been cheaper to put that commission on a credit card, and often it would be. That's a bit of shocking information there. With CDSCs, it's often cheaper for the investor to have paid that commission via a credit card, and few people are aware of that because you didn't even know you paid it. So that, again, that was and is currently still the power of CDSCs, is that you don't see that commission. And because of the way the industry presents it to you by saying contingent deferred, you're under the impression that you haven't paid anything as long as you don't sell it. But that's just not, mathematically, if you give your money to a legal entity and they hold on to that for a certain period of time because they've advanced a commission payment to your representative, then the commission was just paid. It's not reflected on your statement because it's coming out at the fund level as opposed to coming out of your money directly up front. So that's the key. $100,000, 6% CDSC, you get your first trade confirmation, and it's going to say you've got $100,000. If you'd invested that in an A share, where the upfront fee, generally it's not going to be more than 5.5%, but let's just say it's 6% in this scenario, and they aren't ever really 6, it's 5.5. But to keep apples to apples, $100,000 in an A share, you get your first trade confirmation, and it's going to say you only have $94,000. CDSE, your first trade confirmation says you have $100,000. And as long as you stay in that, it's not going to ever reflect that you just borrowed that money, but you did. Because what happens is when you're in a contingent deferred sales charge option, there are additional fees that are tacked on, and those fees are used to, or allows the mutual fund company to repay themselves, which is money that otherwise would have gone into your account. So that's, you're paying for that, whether you're in it for a day or 7 years, you are going to repay that amount of money. So my argument is, it's not contingent and it's not deferred because you're paying it. And if you invested $100,000 in a mutual fund company, and the CDSC was 6%, if you called up 2 weeks later and said, "Hey, can I get my money back?" They're going to say, "Absolutely," and you're going to get a check back for $94,000. Now I know that's the contingent deferred part that they say, well, you sold it, but even if you don't sell it, you still borrowed that money. Your broker was paid $6,000 for which you are responsible for repaying. So you're going to repay that through extra fees tacked on, or you're going to repay that when you sell it if you're in that holding window. And even if you're beyond the holding window, what happened was you repaid it, and that's another issue. I'm at 9 minutes, so bear with me. I'm going to try to keep this to maybe 11 or 12. But so what happens is, once you've repaid that $6,000, and let's say the CDSC was 8 years in this scenario, but in year 6, because the market's doing well, you may have repaid that. Well, what happens is a mutual fund company has what they call a conversion year. And that conversion year may be 10 years. And at year 10 is when your B share gets converted to the lower costing. I'm not sure I made sense with that last little explanation. So there's a contingent deferred sales charge. Let's say it's 6%, meaning you're borrowing on a $100,000 investment, you're borrowing $6,000 from the fund company, and that got paid to your broker. But they don't really have to tell you that because it's disclosed in the prospectus, and you're not going to figure it out unless you see one of my videos, because your financial statement's going to say you have $100,000 still in your account, but you don't. So since you borrow that money, you're having to repay it. If the holding period is 6 years, but the conversion year is 8 years, what that means is, even if by year 6 you've repaid the $6,000 loan, you would think, and this is kind of getting a little bit in the weeds, but some people are going to get it. You would think what happened is the mutual fund company would stop charging you that additional fee that they've tagged onto your account to repay themselves. But that's not what happens. What happens is they're going to, if the conversion year is year 8, they're going to leave that additional charge on there for 2 more years. So you've repaid the loan, but the fund company is still charging you interest on the loan even though you've already repaid it, if that makes sense. And that's actually something that I uncovered when I was coming up with my original algorithm. I was doing the math on this, and I saw that there was that differential between the holding period and the conversion year. And in doing further research, I came across SEC report where this commission actually said that they thought that that was a problem for the industry, or it was a problem for the industry when they continue to allow these fund companies to charge you that interest or the extra fee, even though you've repaid the loan that you never knew you even took out. It's getting a little complicated, And maybe I'll come back and do another video on that, on conversion here. But let me, at minute 12, let me give you a definition of contingent deferred sales charge presented by the industry. And that kind of bring home the point that it may have been intentional the way it was presented to you, the public. So contingent deferred sales charge, a type of fee that investors pay only when they redeem fund shares, and that typically decreases to zero if the investor holds their shares long enough. So let me repeat that again. Contingent deferred sales charge, a type of fee that investors pay only when they redeem fund shares, and that typically decreases to zero if the investors hold their shares long enough. Now that really, if you were just retired from working at Exxon for 20 years and you're rolling over a 401k, you don't really understand how any of the share class or these options work. I think the average person would walk away thinking, well, I'm not paying anything as long as I don't redeem my fund shares. And the great news is going to go to zero if I hold it long enough. That's not how it works. If you invest $100,000 and the mutual fund company advances 6%, that commission, and they hold your investment until you've repaid that, a commission was paid. It was paid by the fund company. It just didn't come out of your money directly initially. You borrowed it. A borrowed commission is the same as a commission like with the A shares where they're paid up front. And I didn't appreciate what I was onto until I started finding these various definitions of contingent deferred sales charge. And I had done the math on it and was like, well, wait a second. They're giving the investor the impression that no commission is paid. And I can mathematically show you that a commission was paid. And you borrowed the money, and I can calculate the interest. And so not only did I eventually prove that I was right, and that there's nothing contingent or deferred about contingent deferred sales charges, but I came across, I'm going to wrap it up at this point, I came across a note from the Investment Company Institute, which is a lobbying firm that represents mutual fund companies, to the and this was a statement given to the SEC in May of 2004, and they're explaining the original rationale for contingent deferred sales charges, and they admit, and this is the quote, the advent of spread load arrangements. So spread load arrangements are contingent deferred sales charges. So let's just leave it at that. So the advent of CDSCs allowed investors to have all of their purchase price invested in a fund, and at the same time enabled fund distributors to advance commission payments to salespersons with the expectation that they would be repaid over time. And when I read that, I'm like, well, that's not what FINRA just said. FINRA said that FINRA says that it's a type of fee that investors pay only when they redeem fund shares, and that typically decreases to zero if the investor holds it long enough. Well, the Investment Company Institute, which works closely with FINRA, they say that the advent of spread load arrangements, CDSCs, allowed investors to have all of their purchase price invested in a fund, and at the same time enabled fund distributors to advance commission payments. So if a commission payment is being advanced, you want to know who has to repay that advance. Well, that's you, the investor, because you just borrowed that money and you pledged your asset as collateral. To a salesperson with the expectation that they would be repaid over time. So FINRA is giving you the impression that commission goes to zero if you hold it long enough. But here they admit that you're actually repaying it over time. So which one is it? Which one is it? So that's not how it works. That's not how contingent deferred sales charges work. So I came up, and I get actually a little teary-eyed when I talk about this, because So I came up with a more true, a more accurate definition of contingent deferred sales charge. And you have to understand that billions and billions and billions of dollars in contingent deferred sales charges have been sold to the public. Most of them having no idea that they paid a commission, or they borrowed the money and then they repaid it. Especially the ones that didn't redeem their asset during that holding period, because then you didn't appreciate that extra fee was tacked on, and then you had to repay that, unfortunately. So the reality is, when you purchase an investment with a contingent deferred sales charge, which is neither contingent nor deferred, not only are you paying a hidden commission, hidden because it's paid from the fund company and it's not disclosed on your financial statements, but not only are you paying a hidden commission unwittingly advanced at your behest and whose aggregate cost runs in perpetuity, but you're also pledging your investment as collateral on a usury loan. I say usury because I can calculate what the interest, the total interest payments are when you invest in a CDSC, and often it's a usury loan, meaning it's a high interest loan, which is why my original point was, often if your investment advisor would give you the option, would be transparent about how the CDSC really works, you could then decide, would I rather put that $6,000 on my credit card and pay 10%, or would I rather borrow unwittingly, unknowingly borrow that money from the mutual fund company and pay 35% interest? I'll leave that up to you. Thanks for watching. And I'll leave some links in the description below to Amazon if you want to check out the books and get a little more information on this. But, I'm basically giving you what you need to know if you own a B share or a C share, or you've ever owned one, which the B share, the structure of the B share is still fairly common in the variable annuity business, where a big commission is paid by the insurance company, but they're holding your investment as collateral. Thanks for watching.